the biggest move that we've ever seen in our lifetime. Bigger than anything that you could possibly imagine for so many reasons. And the capital expenditure that companies are spending on this movement is somewhere 1 to 2 trillion, plus the promises of companies that are investing. We've seen Micron invest to upstate, $100 billion facility. We start to see more and more of that. Foreign direct investment coming into this country. All of that is stimulus. When we have all that stimulus, you have an economy that grows. If you look at last quarter, we were up 4%. Projection for this next quarter is around 5%. I don't think it'll come in at 5% if it comes something less than that. But even so, growing the economy like that, what happens as it relates to subs is it transfers into earnings for the S&P 500 that will accelerate. And that's why I believe markets can be up. But let's talk about the fight. What's this fight all about, right? Well, the fight's about really 3 things. Number one, when you had the second year of presidential cycle and you had midterms, there's volatility around that. So watching Trump's approval rate will give us a sense on what's going to happen with the midterms. And that could change some of the growth agenda that the current administration has. That's number one. Number two, when you have a new Fed chair, there's volatility around that because the market tests the new Fed chair, especially if the market senses that the new Fed chair is not going to be independent. And then third, which is probably on a lot of people's minds, is the geopolitical unrest that we'll all feel. And especially the volatility that we just felt the past couple of days. So, and for these reasons, I do believe that we'll have a 10 to 20% correction this year, much like we saw last year. However, that doesn't mean you sell all your stocks, you go to cash because there's tax consequences of that. I could be wrong. I've been wrong before. My numbers, if you look at all my media presentations, I'm at around 70% plus in terms of accuracy. We've studied that as a firm. So there's that 30% that someone could be wrong. But it's just something to be aware of. It's important for rebalancing, maybe raising a little bit of cash, and being understanding of volatility, I think, is what we're going to probably be heading into. So the key things that I want to leave us with, besides what we're talking about in a moment, is key philosophies that I think about and read every single day. Market timing is impossible. No matter what anybody says. I've tried it personally. I've been doing this for 26 years. And if I thought it made sense, I would do it all. I would invest that way with your money. But there's way too much risk in doing that. So statistically speaking, from 1928 until now, the S&P 500 has averaged around 8%. If you miss the best 10 days per year, every single year, your return goes to negative 13%. That's tremendous. Well, some people say, well, what if you miss the 10 worst days? Well, good luck doing that. So that's why we always say as a philosophy, not to time the market. I'll give you another example in the story. I have a story from both sides. In 2016 November, when Trump got elected, a client called me up, extremely astute client, really intelligent. We never timed the market. He called me up, he said, Phil, sell all my stocks in my portfolio. I'm going to call Mr. Smith. Mr. Smith, you never do this. You're never erratic, you're never emotional. Because Phil, I just don't feel comfortable. I talk him out of doing that. His portfolio since is up 2 times. And thanks me till today because he didn't make that decision, make my mistake. And when Trump was president during that period of time, the market was up over 100%. So now let's go to Biden. Biden gets elected. Literally sitting at my in-laws' house at the dinner table. And after Biden won in November, and my father-in-law says, my friend Aldo, who's been doing this for 40 years, investing money, he said, sell all your stocks, get Biden to president. I literally sat at the table and I managed their money. I sat at the table and I shook my head and said, oh my goodness, here we go again. Fast forward, throughout value frequency, the market was up over 95%. My point is that forget your emotions. Your emotions get you nowhere. See, I have emotions too. I'm not a robot. However, I'm trained and we're trained to coach you through to make sure you'll make these important mistakes that many people make. That makes a difference where you can never ever make it up. I say it all the time. People today who get ready to retire, they should have 2 to 3 times more than they have. The reason why they don't is because they made major mistakes with their money. Holding cash too long, getting out at the wrong time, getting in at the wrong time. And this is why I believe the biggest value that we can present to Ripple with our clients. Just a couple of things that I want you guys to remember. Economists have predicted 33 of the last 11 recessions. Economists have predicted 33 of the last 11 recessions. Far more money has been lost preparing for a correction or anticipating corrections than corrections themselves. When I'm sitting down with my team in our investment committee meeting every 2 weeks, the first thing I say to them is, I only want to spend 5% talking about macroeconomics. It's great to pontificate about it, it's great to have your opinion, but I only want to spend 5%. I don't want to spend any more content about it because it's a waste of time. 95% of the time, I would focus on the investments that we're invested in or opportunities out there that we want to invest in. Macroeconomics and your emotions and your thought process about where you think those are going is a waste of time. Not doesn't mean that we're not intelligent, we don't understand, and possibly we're right sometimes, but 5% of the time macroeconomics, 95% of the time your investments. And doing this 26 years, number one thing that I realize is the best way to create value is to buy great businesses at a fair value or fair price and let them do the work for you by compounding value over time. That's exactly what we're doing for you. Owning businesses that dominate in what they do, and we believe they could dominate for long periods of time, generate lots of free cash flow, reinvesting that free cash flow at high rates of return, and let them consistently do that year over year over year. And that's how you build wealth and compound wealth over long periods of time. And then finally is diversify, not diversify. That's a term that was coined by Peter Lynch, which basically means you don't need to own 100 stocks. You don't need to own 200 investors. You could have diversification with 10 great businesses in different sectors. So as a firm, I'm a big proponent of owning great businesses, stay concentrated, diversify with asset classes that one zigs, the other one is zag, that protects you during difficult times. But overall, it's got to be a mindset that you stay concentrated but diversify in a smart way. And then finally, plan. Having a financial plan. I always say an idiot with a plan can beat a genius without a plan. And two, from Schwab, those with a plan grow their wealth by 2 times more versus those that don't have a plan. So from a financial planning standpoint, we always talk about investing, which is really important. And that's a big bulk of our conversations, but the plan is even more important. Any Q&A regarding this, as we finish the meeting today, we can follow up any questions that you have. So thanks to everybody for listening to that first in terms of perspective. Now the transition over to the emerging market strategy, which is one of my favorite topics to discuss. So quick background, just to remind everybody. So the emerging strategy is something that I thought of, which we thought of, and recognizing that the biotech sector and the technology sector are 2 sectors that have crushed the S&P by almost double over long periods of time. So we said to ourselves, well, if we could find talented, skilled portfolio managers that specialize in these 2 areas, who have a track record, put it together in one strategy, which we call Palumbo Emerging Growth Strategy, we believe that we would have success for you in growing your capital. And that's exactly what happened. So before I get into the details, first, I interviewed numerous people, both on the tech side and also on the biotech side, and I found Mark Weiss and Mark Pantopoulos, which people who've been here now for the 3rd time know who they are. But just to remind you who they are. So Mark Weiss, if you raise your hand. Mark Weiss holds a bachelor's in electrical engineering from RPI, master's in electrical engineering from Cornell University, and an MBA from Columbia University. Mark Weiss manages money for a couple of billion-dollar family offices, and with the strategy that he runs for them, which is a loan-only tech strategy, his track record now is average 17.77% as a loan-only strategy, not a hedge strategy, the loan-only strategy, 17.77%, with the NASDAQ did 12.63, and the S&P has performed 8.92. So not only is Mark a great guy, a salt-to-earth type person as Mark Pantopoulos is, he knows how to perform, and he knows his craft, and that was really important as he built this. Mark Pantopoulos. Mark holds a bachelor's from the University of California, Berkeley in molecular cell biology and economics, and has an MBA from Wharton School. Mark Ventopoulos started his hedge fund in March 2016 after owning his own pharmaceutical company, and since he launched his hedge fund in March 2016, he has averaged 20.7% compounded average growth rate versus the NASDAQ Biotech Index up only 7.9%. So what we're going to do now is we're going to get on stage. I'm going to ask them a bunch of questions that are related to the strategy, and then we'll follow up with you have the ability to ask us any questions that you have, and we'll go from there. So looking forward to this. Mark, you guys want to come up? Test. Good. All right. So the only issue that I had with both Marks is they both are named Mark and they both end M-A-R-C. So we're going to go Mark W and then Mark P. All right. So hopefully we can manage that. All right. So the first thing that I want to review with both of you, well, first of all, thank you so much for doing such a great job for all of us. My own person, yeah, thank you. Good.
Thank you.
Since we launched the strategy just over 2 years ago, the strategy has averaged 31.10%. And the stocks alone, because sometimes we'll have some cash in there for whatever it may be, but if you just invested solely in the stocks and you were 100% invested the entire time, the average was 37.43%. During that period of time, the NASDAQ did 25 and the S&P did 21. So the strategy really has been, I have 40% of my own entire portfolio in this strategy here. That's how much I believe in it. And the great thing about both Marks is they're an incredible resource to the firm and guiding us through technology and biotech and everything that we own. So first thing I want to start with your incredible track records, as a portfolio manager, we always talk about this strategy is about owning businesses that will go up 5 to 10x or even 50x. That's our goal, your goal. How do you identify those opportunities?
Well, you first start with, you have to find where the puck is going in terms of new markets. And then you have to find who are the companies that are players in that market, figure out who are the good ones. A lot of it is the quality of the management team is always very important, but it's really about understanding that moat. When you hear Peter Thiel talk about tech investing, he's always looking for he goes, I don't want to invest in the company that makes a commodity. I want something close to a monopoly, because that's where the profit margins are. That's where the return on invested capital is, and that's what really drives your free cash growth. And then a lot of it is also about valuation starting point. So we think it's a very good example right now, right? Whereas big trends are electric vehicles, autonomous vehicles, and you have Tesla worth about $1.5 trillion. Obviously, there's a robotics play there as well. But boy, it is trading at like 100, 150 times 26, 27 free cash flow. That's kind of up there. There's a lot of future execution priced in there. Meanwhile, there's these new things called eVTOLs that are trading around 5-10 billion. Archer and Joby. These are helicopter-like things. They take off like a helicopter. They fly like a plane. They're 100 times quieter than a helicopter. They're far cheaper. They are targeting reliability and safety of a commercial airliner, which is 200 times safer than a car. So these in helicopters are like 13 times more dangerous than a car. So what if you could fly, from here to Kennedy, 10 minutes, cheap, reliable? We think it's going to be a massive business. We think these businesses can be worth $200, $300, $400 billion one day, and right now they're 5 and 10. And we think that's a much better opportunity than trying to own Tesla at $1.5 trillion.
So Mark, going back to what we said before, so Archer is a company that we own in our portfolios. That's an emerging strategy. They're an eVTOL company that Mark has a big vision for that. So a big part of you identifying companies, does it start first with having the vision for understanding the new industry that they're going to be in?
Yeah, it's about trying to see like whether it's going to be something that's small today, where people are very skeptical, very few analysts, right? Like Google, Microsoft, you have like 30, 35 analysts cover these stocks. The buy side has 10 times that number. Everyone knows those stories well. But things like this, when they come public, maybe they're covered by 3, 4 analysts. People really aren't watching it.
Right.
And that's where you can find, they say, free market theory says you don't find $20 bills on sidewalks. But you find it in the stock market where people aren't paying attention. And that's where there's opportunity.
And one of the things that we talked about is, investing where people are not looking, where everybody today in the marketplace, what's everybody doing? What's everybody talking about? Where's everybody investing today? Right? NVIDIA and Microsoft. Now, not that we don't own that for you, but like this strategy is about identifying companies where nobody's looking. That's what it's about. So Mark Pentopoulos, let's talk to us about how do you uncover these major opportunities in the biotech space, which is really a challenging space to be playing in.
Yeah, I think, though, many of the things that Mark said kind of do translate over in the sense that you're looking for a big opportunity, either a disease area or a big change in the way healthcare will be administered that, opens up a big opportunity for new players. And then it goes to some of the things that Mark said. We're looking for a quality management team. We're looking for a moat, intellectual property. And we're looking for a path to, get to that market. So you just look at a couple core things within a company, the intellectual property, the size of the opportunity, how much capital it takes to get there, how long it takes to get there, and most importantly, is this a team that can get it there? I think at the end of the day, you can have the greatest technology in the world, but if you have a bad management team, the odds of really monetizing that technology are quite small. Versus if you have mediocre technology, but you have a fantastic management team, they will figure out a way to really monetize that opportunity. So, it's those core factors that we look for, and then as managers, our job is to buy it at the right price, right? So you want to look at buying it at a valuation when it's out of favor, not a lot of analysts covering it. I sometimes liken what I do to second wave investing, which is, there's a lot of hype that comes up first. Everyone's excited about it. Doesn't quite pan out. Some issues. Everyone forgets about it. They get disappointed with it. But the right management teams, they figure it out. They figure what went wrong. They improve it. They get it to a working model. And that's the time to get involved as an investor. So, a lot of times, our job really is to find those opportunities, which means we get out there and we hunt. And that's essentially, what I do on a day-to-day basis.
Management. So how important is management as it relates to your sector?
Critical.
Like what percentage would you say?
I mean, you can argue it's 100%, right? It's in the sense that, if you think about, if you're looking for a good opportunity, if you're looking for a really strong intellectual property, if you're looking for a path to getting to that opportunity, getting through insurance companies, getting through the FDA, doing all of these things, if you have a really great management team, they'll take care of all those things for you. They've already looked at the IP. They've already looked at the opportunity. They already know the path to getting this drug approved or this device approved and getting it on the market, because they're not going to waste their time if it's not all lined up.
What are some of the traits that you see in poor management?
You typically, just poor execution. What you see with strong management teams is that they bring in strong teams. So they like to have a strong team underneath. They like to be able to delegate all these things, and they just kind of make sure that things are going, well. They like to have a strong board that holds everyone accountable for the actions of the management team. So those are the things you can kind of look for, and then you just want to look at their past track record. Sometimes the best investments are ones where the company has had some issues. It's kind of fallen out of favor. Then they bring in a team that's done a great job before, and to take it over. And if you look at if you look at the two big acquisitions that have recently occurred that Merck bought, one was Verona Pharmaceuticals, the other one was Sadara. Two different situations here. One, Verona was a management team, new management team that came in, that turned things around, and they did that with Verona. They had done that before with a couple of companies, and then they did this with Verona. With Sadara's case, you had a very experienced drug hunter, but who struggled, as a CEO, but he knew how to find drugs, and he knew how to spot things that were really interesting, and he spotted some technology, and he turned it around. So in that case, he kind of went through his evolutionary process in terms of being able to kind of get that big win. But you have to kind of watch what they're doing and understand their mentality and how they do things and how successful they typically are. And then you have to think about how much position sizing you want in the portfolio based on the dynamics that particular opportunity presents to you.
So, in a lot of investors, if they looked at a lot of these businesses that we own in these portfolios, these are businesses that aren't these large companies like Costco or Amazon. These are smaller companies, mid-sized, sometimes micro-cap type companies. So, when owning these companies, when I look at it, I see they're very volatile, but yet they're like Navy SEALs, where they just don't get affected because they believe so much in the companies, the management, because they're so involved in understanding that. How does an investor get over the emotion of these businesses that they have lots of debt? It's a bet on future free cash flow, which is a different philosophy than the core strategy that I run for my clients. So walk us through like the risks of these. How do you think about that, and how do you kind of get over the emotion of the volatility of owning these individual companies?
You have to drink wine. No. It's you have to see volatility as opportunity. If you look at it that way, if you like a stock at 70 and then it's 35, but the story hasn't changed.
Right.
It's other people's emotions maybe driving that stock down. And if your fundamentals that you really see are still there, that's what enables you. And you see a pathway for how a perception can change. So if you see a company it's a great company, but they got 5 quarters of cash left, and then a new management team comes in, takes expenses down by 30%, does a pipe, gets capital in company. Oh, now they have 12 to 15 quarters of cash. That's a catalyst, and a lot of times people are not even looking for those catalysts because some stocks could be down and out because of past mistakes by other management teams that are not present anymore. So volatility can be your friend, but it's hard to stomach it, and people it's hard not to be emotional. You really have to try not to be emotional.
I love that. Volatility is your friend, and that really is true. So, Mark, in your industry, in your sector specifically, I feel like it could be even more challenging, right, than the tech sector.
100%.
Right. So walk us through how you become almost unemotional and how you manage through the volatility.
So I think a lot of it is position sizing, how you position size. If you've felt very comfortable with the management team, it's at the right valuation, you really see the execution going well, you feel comfortable having a larger position. Also, there's a different risk parameter if a company is close to profitability, or it is profitable, or you have very strong phase 3 data, than if it's an unprofitable company and it's very early stage. And so, the earlier stage ones you don't know as well, even if you really like them, we tend to be take a smaller position so that if it does get cut in half, we're not losing 5% in the portfolio because of that. We're losing a much smaller amount, and that gives us an opportunity to follow it and understand how the management team reacts to whatever has happened to cause the stock to go down. I would say that the really defining factor about those teams that are successful versus not successful is how they deal with setbacks, right? I mean it's very telling, how a management team deals with setbacks when problems come up. Are they, do they just kind of stick with a game plan, or do they start to change, tell a different story? That's when you have to start worrying. Is when what the story you heard 5 months ago is a different story than what you're hearing now. And the other thing too is looking at management teams that are really they're there to. You want a management team that's there to make money off of the appreciation of their stock, not their salary. That's really, a very telling thing when it comes to these management teams. So, I guess that's a long way of saying that the bigger positions are in names that are not a one binary event in clinical data, which means it's either, up 400% or down to zero. And then, taking smaller positions in those types of names, and also watching the management team. And then over time, as you get confidence in their abilities, and as you see the stock price come to the price where you think it represents a very interesting risk reward, then you take a bigger position at that time.
And for both of you, I'll start with you first, Mark Patopoulos. So how do you cut your losses? How do you say to yourself, okay, this is my thesis, this is why I'm owning it, but something's changed. So what makes you say to yourself, I'm going to cut my losses?
I have no problem with that. It's actually, sometimes I cut too fast sometimes. It's when I clearly see that something has changed with the company, and it could be something that's happened within the company, but it could also be something that's happened on the competitive environment side. There's a lot of things that can change, right? So if this company could be doing really well, but a new technology comes along and it's just going to really eat their lunch. Well, you got to get out of the position at that point in time. Could be that all of a sudden, reimbursement gets cut, and they can't make money. Doctors can't make money, with this product anymore. You got to cut it because it's going to go down.
How about you, Mark?
I think the most important thing is patience. It's the biggest possible mistake you could do in tech investing is selling your 20 bagger before it happens. It's so much better. It's like if you're trying to optimize, I make 20 bets at $1, maybe 5 of them go to 50 cents. If you try to optimize, say I'm going to get out at 65 cents instead of 50, but in trying to do that, you jettison the ones that go up 20, 30x. You just defeated the whole point of what you're trying to do. So you need to wait. You got to be patient. And it's hard because the stocks are under pressure. It was I was watching a video of the Co2, the two brothers from Co2 from this summer, and they were showing a graph going, OpenAI is the fastest growing thing ever, and we've been tracking people that have subscribed to OpenAI, and their traffic on Google starts dropping. And it was obvious that OpenAI was all search was going to go to AI, and OpenAI was the top brand, most downloaded app across all the countries in the world. It was all over for Google. And now people are worried about OpenAI survival. Google Gemini came out.
Right.
They have the TPU. They have a much lower CapEx cost as a result because it's their chip. They're not giving Jensen 80% gross margins on his overpriced chips. And guess what? Now it looks like Google's going to be the winner, and now I think they're the most valuable of the Mag 7. I think they passed NVIDIA today. They're north of $5 trillion. And they're up in the last from 12 months a year ago, I think they're up like 59%. NVIDIA's up like 25%. Meta, Amazon barely moved at all. Same thing with Tesla. So it went from something that was an obvious, you got to get out, to now what's the best story.
Yeah, it's unbelievable. I've been public about this. So I get this a lot. Who's going to be the biggest winner of this AI race that we're seeing? And I believe it is now, and it's going to continue to be Google. That's my personal opinion. You don't have to agree with that, but my personal view is that it's going to be Google. I think they're doing a phenomenal job in every aspect. So let's get into artificial intelligence. Like I said, it's the biggest revolutionary move that we've ever seen. So the way we bucket AI is really in 4 parts. One, is the language learning models. That's the ChatGPT and Gemini that we're going on and using. That's one bucket. Second bucket is the physical AI, artificial intelligence, which is eventually the robotics. Then there's self-driving. And then there's healthcare. Then you could add finance into that and applications, et cetera. So Mark, walk us through, we had a presentation like this 3 years ago, then last year. So where are we with AI as it relates to these buckets that we just talked about, or just AI in general?
Well, in the large language model bucket, it looked like it could have been a bubble this last summer. There was very little deployment. There was a lot of issues with the AI writing software. A lot of people consider the code to be garbage. And now you're seeing like some of the top-rated, staff-level engineers, like people that like have followings because they're like, top programmers at Meta, like they're like going, wow, Anthropic has gotten so good, and the code quality has gone through the roof.
It's amazing.
And it's actually causing a software stock sell-off. So it's really gotten, and now you're starting to hear more serious deployments of AI agents. This summer I was thinking AI was.
Can you explain AI agents?
It's like a virtual robot. So it's not a physical robot, but it's something that goes out in the world and does stuff for you. So it's like instead of you having, if you're an analyst and you have your junior analyst, you give your junior analyst stuff to do, you would give it to your AI agent to do. And it looked like that AI models had kind of maybe peaked out. They weren't going to improve much more. The error rates were too high, the hallucination rates. And so doing work was going to be hard, but being a better search engine was actually quite valuable, but it would be more of a capped story than an open-ended one. And now I think the evidence is starting to shift more towards it's going to be very open-ended, which is why you're seeing now the shortages for the AI infrastructure. First it was like shortages of NVIDIA chips. Now it's the CoWoS packaging, the HBM memory, the indium phosphide wafers to make the optics to connect it all. You're seeing shortages across all of these things. And it's because the infrastructure is really getting rolled out because the economic case for it is really strong. AI robotics, if you watch those All-In podcasts, one of the guys on the All-In podcast, he said he just was at Tesla, and what he saw in the lab with the third version of the Optimus robot, he goes, this is going to be massive. And so people are really impressed with what they're seeing. Now that is a mixed thing. There's a lot of people that think it's impressive how far they've come, but they're still far away from really being practical.
Yeah, but do you think with Tesla, what Musk is talking about in terms of the amount of robotics that he's looking to manufacture and the numbers he's talking about, do you think that's realistic? Or is he just doing what Musk always does in terms of...
Well, I think he's mentally preparing for it. He was on, the Diamandis and those guys,
yeah.
and he's talking about building his own semi-fab, because what he's thinking about is, I don't want to pay TSMC a big markup. I don't want to buy chips from someone that's paying TSMC. I want to build my own fab, so I have the lowest cost silicon. So I can drive down the cost of these robots to be as cheap as possible. Which is going to be the
key, right?
Yeah, he wants a low price. And look, this is why you have to be careful. Like, we do venture investing as well. There's this company out there called Figure AI. They raised money at a $40 billion value. I think they had 2 robots at a BMW plant in South Carolina. I'm like, man, that's like $20 billion a robot. That's pretty up there.
So Mark, there's basically phases of this AI. And the first phase is these language learning models. Just talk about this we call second, third derivatives of the language learning models, which is the power issue, the memory issue. So within the portfolio, we own Bloom Energy, we own Oklo, which are companies that will help facilitate power to these data centers. So just talk a little bit about that.
Well, when you listen to Elon Musk, especially in that Diamandis podcast,
right.
He just says it's the power. It's absolutely the power. Well, just a very quick, interesting story. So there's a company out there called, they're building, it's called Boom Supersonic. They're building a next-gen Concorde. They did a big
Right.
recap. A lot of
Right.
guys got wiped out, but they make their own engines because they realized if you pay Rolls-Royce and GE, they make the money. You'll never make money making your plane. So he had to make his own engines, and now they have like I think $300 million book of business. Their plane can't fly yet because they got to go through all the FAA stuff, but the data center guys are buying their engines because they need the power. So jet engines are being used to power data centers.
Right.
That's how desperate these people
Right.
are. So if you're Bloom Energy and you have a fuel cell, you put natural gas in, you get electricity out, you're going to sell all you can make. And we just got an Oklo, which, boy, we had a great run in it. We sold half of it because we thought this is just getting crazy.
So Oklo, just explain, is nuclear. Just
Yeah,
explain
yeah.
how
It's an SMR, small nuclear reactor, but they just committed. A
Yeah.
big deal to them
Yeah.
because Meta's like, we don't have access to power. And the great thing about these SMRs, particularly Oklo's architecture, they say that we have in the United States, from the existing nuclear waste at the old power plants, I think we have hundreds of years of electricity to power the United States by recycling the nuclear waste that's there. They don't even need one new, they don't need any uranium mining, just recycling what we have. And by the way, they clean it up. Stuff that's radioactive for 10,000 years end up with stuff that's radioactive for hundreds of years. So they actually make the waste cleaner, and they're going to sell isotopes. They have billions of dollars of isotope streams. And it's really, I'm amazed at how the stories come along.
So with robotics, physical AI, so Symbotic is a company that we own in a portfolio.
Yes.
So talk a little bit about Symbotic as it relates to that bucket.
Well, Symbotic is it's a really interesting company because the humanoid robotics are cool and they make cool demos. Are they being deployed? Is anyone really using them? No. Now, it may not be that in a couple of years that could change, but today, all of Walmart's 42 distribution centers are going to go 100% with this company called Symbotic. This thing's actually up and running today. Now, these are not humanoid. They build a big 3D chassis, and they have these robots that go across X, Y, and Z. Pallets come in, all of the same stuff, and then they have to repalletize them, take things from 30 different vendors and build a pallet. And they build these pallets for a lot less money. They do it faster. They can build taller ones because they have the computers figuring out the geometry and how to stack things better than humans can do. And I've been to the facility in Florida twice. The first time I went, you see all the old stuff that's there. And the second time I went down there, it's now like 2/3 empty because this thing saves a lot of space. And that's their first generation. The next one is, I think, it's like half. And they can build it in 1/3 of the time. They took all the rivets out. The thing self-assembles. So and now they have something called Greenbox, which is a joint venture they have with SoftBank. And they're going to do warehousing as a service. And the beautiful thing is, Amazon has been raising prices on third-party sellers. They used to take 10 to 15% of final price. They're now taking 50% of final price when you include advertising. So they're giving us really good margin. They estimate it's a $500 billion opportunity, warehouse automation. And this company's worth $40 billion today. We think it has a chance to get to a $500 billion to $1 trillion because they're going after a market that's just massive. And they have all these, so they're getting into now medical area. They're getting into refrigerated goods. They keep expanding, and it's here and now. So that's like, if you want a robotic company today, that's kind of like the one and only you can buy.
So in the various buckets that we just talked about, the LLM models, the physical AI, self-driving, we have Archer within the portfolio. And as far as healthcare is concerned and AI, right, where are you seeing AI penetrate the healthcare sector?
Yeah, so the easiest and first is in diagnostics, right? So this is to look at images and to understand, okay, this is the image of this diseased tissue, so therefore, it's this disease, right? So this is talking about pathology labs or just other ways of looking at a scan of the body in some sort of way, or looking at a cell type and being able to kind of diagnose it quickly and readily. And that's kind of the first where AI kind of really started to make its first headway. Then it kind of goes into trying to predict disease. The potential for using AI and robotics in surgery is something that's kind of front and center and coming along. And people are also using it in the realm of drug discovery. Now, with drug discovery, it's going to be looking at kind of the physical nature of the target, the physical nature of the compounds you want to develop against it. It's less developed in drug discovery, partially because we don't fully understand how the body works, right? If we completely understood how the body worked, we could say, well, we can just design this molecule very quickly, but we don't. And so therefore, it's the applications outside of simply looking at images and making a diagnosis are slower because we still have to prove that, that we're predicting what was said. A lot of the early kind of AI companies in drug discovery have had some setbacks. Their drugs didn't work quite as well as advertised. Even with the use in diagnostics and looking at predictive markers for things like cancer and things like that, you still have to come up with the algorithm, look at the markers, design a system, and then say, okay, well, retrospectively it looked really good, but does it work prospectively? Is this marker predictive of the fact that you would get some sort of disease or cancer, something like that down the road? So, unlike an LLM where you test it right away, say, okay, does it work? What's the response? Does that sound right? With healthcare, it just takes a lot longer to say, yes, it does work. Yes, it is predictive. Yes, this is a better way of doing it. And we're getting there, but it's just a slower process.
Are we there yet, though?
No. I mean, for diagnostics of, like, if I'm going to look at cell types, and I'm going to look at, a million different cell types and tell you which cell is cancerous versus not, yes, we're there. If you're talking about, using AI to come up with the optimal drug to treat some disease, we're not even close.
So I want to turn to, so we talked about all the positives and companies that are performing well, but the one area that hasn't been performing well is the software sector, with the concerns of the overhang of AI and how it's going to infiltrate some of these businesses. So within the portfolio, the areas that haven't been doing well is Snowflake and MongoDB.
Well, Snowflake's up year over year.
Year over year, they're up.
Yeah. Is it because it's infrastructure? MongoDB and Snowflake are up. Their databases. It's the application guys.
ServiceNow,
the application guys have the
Salesforce.
problem.
Right. So talk us through software, where you see the opportunities. Does the market have it right? Let's take ServiceNow and Salesforce, which are down from their highs, right?
No, it's a very good question. And we think there's a fundamental overreaction happening. There's always well, first of all, there's different levels of software. Stuff like file systems, operating systems, databases. That is like the pinnacle of software development. Most people that learn how to code have no idea how to code those things. To mature those things takes decades, right? You just can't, you make a new database, it'll work, but does it work in every corner case? It takes 10 years to get a database really beaten down and ready for people to use it. So you can't do that overnight. Applications are different. Applications are built on top of operating systems and file systems and databases. That's easier. And that's where, if Anthropic makes this big leap forward in software quality, you can say, oh, I can make my own Salesforce.com in a day.
Yeah, but doesn't that take a long time to do? I mean, Salesforce has been at this for the longest time.
For a long time, but
They're a $200 billion market cap company,
yeah.
right?
Well, the thing is,
How easy is it for them to do that?
Well, look, the idea that if you get this big boost in developer productivity, that suddenly people that would buy software from them, that you can just do it yourself. The simple fact is the largest software market out there is do it yourself. You look at how all the banks run, that's all code they wrote themselves, right? I don't know if any of you used Cash Pro from Bank of America, but boy, that's not a good development team. That is not good. I don't like using that code. So we think what people are mistaking is there's a vibe coding, using AI to code, is making all developers more productive. But the best teams are at ServiceNow and at Salesforce. So they're not making their software better at a faster rate.
So do you think it's a great, owning I know we own these businesses right now, so do you think from a buying standpoint, it's a great opportunity.
Look, some of these names, I understand people are worried about the franchises, but a lot of these things now are at 15, 20 times, like
Right.
26, 27
Which
free
is
cash
amazing.
flow. Mag 7, the cheapest one's at 40 times.
Right.
They're trading at 50, 60, 70 times, 26, 27 free cash flow. And by the way, it's not like they're great growers. None of those things are growing north of 20% a year. They're all like mid-teens, which for companies of that size is amazing, but they're not growing top line 20, 30%. And some of our companies are. Snowflake's up there, MongoDB's up there, CrowdStrike's up there. So we think there's going to be eventually a swing back into software. But we're staying an open mind because the ability of AI to make great code, it's like in the last 3 months, night and day.
Yeah.
It's gotten a lot better.
So, Mark Patopoulos, in terms of opportunities in the biotech sectors, right, that you think really can thrive, where are you seeing the opportunities?
This is for the application.
And particular companies.
For AI applications. Is it in
It
particular?
doesn't have to be, it could be anything.
Okay, I mean-
Anything related to the biotech sector, where you're seeing opportunities.
Sure.
over
I
the
mean,
long term.
with regards to AI, I think there's a huge opportunity in neuro and in the ability to read brain waves, to kind of turn limbs that have been affected by things like stroke and things like that back on, to understand mental health disorders much better, to intervene either mechanically with a device or with new drugs. I think there's huge applications there for AI. With regards to just the general biotech space, it's been out of favor for, especially the small names, have been out of favor now for going on 4 years. So we're finally kind of turning the corner after kind of a 4-year brutal bear market in biotech. And I think a lot of that's been driven by renewed interest in M&A. And I just broadly think in terms of biotech, the next few years should be quite good for biotech because we're going to get a continued wave of M&A from large pharmaceutical companies. And also, smaller biotech companies have learned how to launch their products more effectively in the market. So there's really opportunity now for smaller companies, once they get some cash on their balance sheet and they can get the drug through the clinic and onto the market, that they can actually drive their own profitability and kind of become the next, I guess, biotech leaders over the next decade or so. So there's just a lot of kind of good swing factors in biotech's favor right now. The other thing, the wild card, of course, is interest rates. And if interest rates, go up a lot, I mean, that's obviously negative for kind of long duration assets, which is where kind of small unprofitable biotech lie. But I think given that the sentiment is kind of really washed out in the sector and we have a lot of M&A activity occurring right now, we expect biotech to be good at least for the next, say, 2 or 3 years.
As far as Mark Weiss, in terms of valuation, so everybody is concerned about valuations. And when I studied valuations, oftentimes, I mean, there was a study that was done in 2015, 20 companies, highest valuations. The average PE was 68 times forward multiple. Fast forward 5 years, the average return of those companies was 14.9% versus the S&P like 12.5%. So people would say, well, these companies are trading at such high multiples. How can that be? And valuation alone doesn't cause a company to go down. So what is your feeling as you think about valuation and all this talk about valuation?
Well, it's if growth solves valuation problems, but you got to be growing north of 20. And so a lot of these, and we don't look at earnings as much as we look at free cash flow because we think that's like what reality is. And right now you're in an investment cycle. These guys are taking, they're building up their capex, especially the Mag 7, and that's going to hurt your free cash for a while. You're going to look expensive. Now, if the AI investment works, then you're going to get a lot of free cash flow generation from that going forward. So you can't. Valuation. It's a good way to think about things, but I wouldn't over focus on it. It's very different from the year. I remember the year 2000. And, companies like Akamai were trading at 200, 300 times revenue. That was crazy,
Yeah.
right? And that's,
Well,
again...
even Tesla now, too, trading at 200 times.
Yeah. Sorry?
Even Tesla today, too, trading at forward.
No, they're trading at 200 times, they're like 150 times projected 27 free cash flow. But that's free cash flow, not revenue.
Right.
Right. So we don't like... Michael Burry, Big Short, he was really right there. He's been calling doom and gloom several times since, so that didn't pan out. So, smart guy, but does not have a perfect track record. He keeps using the word bubble. Bubble, I lived through a bubble. I was there in 2000. I watched JDSU go from a really crappy optical component company, single-digit stock, go to $120 a share, and then went back down to $2, $3 a share and stayed there for a decade. That's a bubble. When you go down 95% and you don't bounce back. Maybe NVIDIA should be worth $3 trillion or 2.5, or maybe it should be 10. But it's not going down to like, 50 billion. It's not going down 95, 99%. That's not in the cards. So there's absolutely not a bubble. Can we have a big correction? Of course we can. But the word bubble should not apply here at all.
Yeah, I mean, as I think about a bubble, does anybody think about we're in a bubble right now? Is anybody? Yep. Any other? So, as I think about a bubble, is I always say if everybody's talking about a bubble, you can't have a bubble, right? Like when I'm talking to my team, I always say, what's everybody saying? Let's do the opposite. So that's number one. And number two, I just think that we're so early stage of this. But do I think eventually this is going to form a bubble? I do. And bubbles are formed because there's wealth creation happening, investors see it, and everybody starts to pile in, and that's when you get that euphoric moment. So I agree with you, Mark. That's not where we're at. In terms of valuation for you, Mark Metopoulos, how do you think about it?
The sector's wiped out. The sector's washed out. It's a fantastic time to get involved.
It is. I know. I agree.
With the biotech sector.
Yeah.
I talked about two companies, Verona and Sadara, getting taken out for around $10 billion each. Those were 10x returns in the last year on both of those companies. The sector's washed out. Pharmaceuticals hunting. Investor sentiment's very low on the sector. And there's a lot of really good new technology with new products coming along. So we feel very bullish over the next couple of years.
I just want to finish off with talking about private investments. So there have been opportunities that Mark Weiss has brought to the table for some of our clients, our team, and we're just getting to build this relationship with Mark, and then Mark Metopoulos also brought up privates. And just to give you some stats on some private opportunities that we've had. First of all, we had opportunities to invest inside Quantum, which is a quantum computer company, which continues to thrive as a company. We invested in Cerebras. That was back in March of 2024, which is now up 4 times our money. We invested in Grok.
No, that one's 6 times.
6 times. And Grok's 4. 4 times. So Grok in the summer of 2024 is up 4 times. I invested in SpaceX, not through Mark, through another opportunity. That's up 2.5x. Since the summer, we invested in XAI recently. So my point is, first, and Mark Metopoulos just reached out to me recently about these opportunities. In the private market, there's millions of companies in the private market. In the public market, we're limited to like 4,500 companies. So all of these companies like NVIDIA, like Anthropic, that's private, and Databricks is private, which I think are going to be phenomenal businesses as they go public, in my personal view. So there are opportunities in the private market that a lot of investors are not seeing or don't have access to. And as a firm, as a resource to both Marks, it's an incredible opportunity, because if you're at a bigger firm, in order to get these opportunities, you have to have a $50 million account, and you're limited in terms of the quantity. So not only is Mark and Mark, as we go forward, we're going to get more opportunities in the private market that could be, we think, advantageous. But let's start with you, Mark Metopoulos. Talk about the private market and the opportunities you're seeing there versus the public market.
Yeah, I think the private market in biotech has suffered along with the public markets. There's a number of companies that had very high valuations back in 2020, 2021 that have come down quite a bit. I think with regards to some of the early stage stuff, some of that stuff I think has not come down as much as maybe it should have, but certainly valuations are not stretched with regards to the private market. And a lot of that's because the public markets just have not, done well over the last 4 years. So there's plenty of good opportunities. And if you think about it, if a company has kind of survived the last 3 or 4 years as a private company and continues to go and continues to develop, that does kind of talk to their staying power since they've survived 4 years of a very bad bear market in biotech. So, typically the companies that have gotten through those periods, they tend to be survivors and they tend to do well in the long run. So there's plenty of opportunities to do stuff in the private market. And as we've discussed, there's a lot of good, interesting stuff outside of the U.S.
Right.
as well.
Right.
And so there are some opportunities to invest in great technologies in public companies that are trading on international exchanges as well.
Mark Weiss?
Yeah, so we feel the best way to understand public opportunities is you have to understand what's going on in the private. Because a lot of because you really can see where like relative value is. And so, for instance, like when we looked at, there's like kind of these two chip companies. One just got bought by NVIDIA, that's Grok with a Q, for about 20 billion, and the other one was Cerebras. And, we were invested in both of them. And interesting to see, that both companies raised money around $6-7 billion valuation last summer. We got in a year before for a half to 2/3 less than that one, and now they are both getting. Now they're both being valued at around 20 billion. So we made in about 6, kind of like a year and a half, 2 years time, like 4 to 6x. But why did we do it? Because we saw both companies had one thing in common. They were having much better performance than NVIDIA. And they were at valuations in the single-digit billions. And I'm looking at NVIDIA at, in the trillions. And I'm going, well, where's the risk? Where's the reward? And the accepted wisdom is that privates are riskier. Not always true. You can find opportunities where it's fundamentally lower risk and more upside. But you have to know what you're doing. And you have to have that scar tissue of how you made mistakes along the way. But once you see the patterns, you can figure out where the cream is and you can get involved. And it doesn't mean everything you do works better, but nothing works perfectly in the public markets either. And a lot of times, we especially have an ability, we get in directly on the cap table. We're buying stock from the company. We're not in the secondary market. So we're getting something called liquidation preference. So we're senior. So let's say a company raises $500 million at a $5 billion valuation, and they raised $100 million before. Total capital in is $600 million. If they sell that company for $1 billion, the first $600 million is going to the preferred stock before any of the common guys see a penny. That's your downside protection. So you can get into a company and you can get your money back if it doesn't work out. Now, if the company makes a terrible product and they burn through all their cash, there is no salvage value. You can still lose your money. But the liquidation preferences buys you a lot of downside protection. I would love that in the public market, that I buy a stock and it could go down 70-80% and I get my money back. But that happens in the private market, does not happen in public.
Great, thank you, Mark. So we're going to turn it over to all of you to answer any questions that you have. Just raise your hand, and Matthew Davey will walk over with the microphone.
With respect to private companies, don't you have severe liquidity issues if you want to liquidate and you're only really limiting to investors who can be in for the long term rather than the short term?
Well, that's why I don't commingle. There's our public money. Everything there's public and tradable. And then if you get people into a venture fund and you tell them it's a 10, 12-year life, then they know up front they're locked up for that time. So yes, liquidity is, let me say this, 20 years ago, big issue. If you get look, for the last year and a half, I get 3-4 phone calls a week. People want to buy my Grok and Cerebras. I can sell those things anytime I want now. So the liquidity in the private market has actually picked up quite a bit.
A lot.
So the liquidity penalty is, now again, I would think the best opportunities in the private market are names most people don't know about. There are just no trading volume. When people know them a lot,
right,
they're already now worth 10, 20, 30 billion, Databricks over 100 billion, and yes, not there's liquidity, but are you getting in at a good price?
So there's definitely risk there for sure. There's definitely a liquidity issue. But what's most interesting, as Mark just said, especially for the quality businesses, there's a market out there, where you can sell your stock that's private. there's more capital, I feel like, today in the private market than is in the public market. So it's changed a lot, but there's still risk there, and it's still illiquid.
Yeah, and like Morgan Stanley just bought one of, there's like these guys out there like Forge Global and
Right.
Equities and now you're seeing like, they're getting bought by major banks.
Right.
Because, so they see that this is a growing opportunity. So we think actually the liquidity in the private markets only increases from here.
And the Apollo CEO, Mark Rowan, he's looking to put together privates where there's daily liquidity.
Yeah.
He was talking about that. So,
Yeah.
Yes, Billy.
Well, my friend across the street runs a secondary private trading market at Morgan Stanley. It's a very active market,
Yeah, very active.
and you do have liquidity. You might not have the spread you want with regard to half or
Yeah.
quarter of a point, but it's there, and you can
Well,
or buy other stuff.
on certain names, like when you look at all the, you go to these sites, you'll see the 50 top 100 names that they're trading in, but there's like names that you want that aren't always on that list. And then what you might, and the problem is you call up a broker, and now they start calling up all the shareholders, and it's like, maybe you want to keep it quiet, and not, so it's improving, but it's not for all the names.
Right.
No, obviously, but
Right.
many of the newer names that are out there.
Oh, yeah.
That are being, marketed are the ones you can trade.
Right.
Absolutely.
Right. But you got to go into it. It's illiquid. It's
Not as liquid, but
not as liquid, yeah, as public markets. But
Thank all three of you for doing a great job on my portfolio.
Thank you,
So
Barry.
Thank you for that. How do you see and when the quantum computing is going to affect the technology in the healthcare?
Well, I think, there's two main approaches to quantum computing. Either you make 1 million qubits with about 10,000 or like somewhere between 1,000 and 10,000 physical qubits to make
could
what's
you
called-
just explain? Could you just explain that a little
Well,
bit?
a qubit is, it's it's sort of like the transistor for quantum computing. So everything's done with qubits. The thing with quantum computers, because of entanglement, you can parallelize a lot more calculations. So a logical qubit means it's like a transistor in that it has a very low error rate, like 10 to the minus 12, 10 to the minus 13. The problem is the physical qubits are like only, 10 to the minus 2, right? So they have a high error rate. So when you're doing quadrillions on quadrillions of calculations, if your error rate is 1%, the error rates build up and you end up with gobbledygook. So to get something that actually works, you've got to get that error rate really low. That means either a big ratio of physical qubits with a lot of error, using all those physical qubits to do error correcting. So you have one logical qubit made up of all those physical qubits, or you make your physical qubit so pristine that it itself doesn't need error correction. So there's those two directions. And most people are in, you got to do a lot of qubits camp. And we think the company that is best positioned to build that real first 100 logical qubit machine with over 1 million physical qubits is a company called PsiQuantum. We do not believe the current public guys are worth taking the risk on. IonQ we think is the best of the kind of the three, but my understanding,
IonQ, the publicly traded.
yeah, publicly traded, but it's worth 20 billion, and they don't really have a working machine yet. Trapped ion, their architecture is slow, and most people, and Honeywell is not going to spin out their unit called Quantinium, which most people that know both architectures, they think Quantinium's better. Then there's Rigetti, who's in the world of superconducting qubits. We think they're like a distant third, with IBM number 1 and Google number 2. And Google has produced some really interesting results, but they are investing in a private company called QEra, as is NVIDIA investing in QEra.
Right.
And it's actually interesting that NVIDIA also invested in Quantinium. So if IonQ is the best guy in trapped ion, then why did NVIDIA invests there. And we also think it's interesting that a Series B investor in IonQ, one of the defense contractors,
The Lockheed Martin, right?
yeah, no, yes,
Lockheed.
thank you. It was Lockheed Martin invested in 2000 in IonQ Series B private financing. They just did they have a strong relationship with PsiQuantum. If IonQ's the pathway forward, why are they doing that?
Right.
Right, and it's also interesting that NVIDIA is also an investor in PsiQuantum, as is Microsoft. So we're watching the guys that know stuff quantum well. NVIDIA has a quantum team better than most people, as does Google. And where have they placed their bets? It's in none of the public companies. So it doesn't mean that they can't win. It just means the odds that they can win, we think, is pretty low. And your entry point, these things are trading at bubble valuations, 100, 200 times revenues. And so, in the end, almost all of these companies lose. There's one right way to do a quantum computer. It's going to be one architecture. They're not all going to be on the same improvement curve. That never happens in technology. Like silicon transistors won for a reason, right? We build everything on silicon chips. That's the superior platform versus the 10 alternatives. That's going to happen here too. There's trapped ion, there's neutral atom, there's superconducting qubits, there's photonic qubits. One of these things is going to be right. I mean, that means all the other ones are wrong. And is that downside probability priced into any of these things? Not now. So be very careful in quantum, extraordinarily careful.
Yeah, I just wanted to know if you have familiar with these three companies that manufacture memory chips that have a versatile monopoly over this market: Seagate Technology, Western Digital, Micron Technology. They've all tripled in value.
Yeah.
And what's appealing to me is they control basically 75% of the market. They really have no competition. Do you see these keep going up in value? You have confidence?
Well, it's the end game, which is why everything is so. It's down to this many number of players, right? You used to have, dozens of companies that made DRAM, right? The thing is, as we got to smaller and smaller dimensions, the number of companies that can build a fab and get the yield up dwindles. So there's 3 HBM memory manufacturers. How many companies can make 2 nanometer silicon? It's TSMC. I mean, for logic, there's TSMC, maybe Samsung, and maybe Intel, right? There used to be 15 companies, and you're seeing this everywhere, right? How many guys make the lithography machines? ASML, it's them, right? There used to be 30 different semiconductor capital equipment companies. Now it's down to Lam Research, Applied, ASML. So all these companies are really well positioned. Now the problem is they've all had big moves. It's very hard for me to tell you, buy them here, it's a good deal.
Right.
It's like they're all adding big capacity. Is there a chance of an overbuild? There always is. But I think over the long term, it's not like we're going to go back to 30 companies making DRAM. It's going to be those 3, but it could drop down to 2. And then if you own the one... Listen, I think these are great franchises, but should you go out and buy more right now? I have trouble giving advice on that.
Yeah,
but they are fantastic companies that have survived while everyone else has dropped out. That's a great place to be in.
Yeah, which is amazing. So just to give some perspective, so basically with the LLM models built out, there's a shortage of power. There's also a shortage of memory. That's the biggest, newest thing that's going on right now. So Micron Technologies, SanDisk are 2 companies that can supply memory, and that's why these stocks are soaring. So the question is do we believe that can continue based on this shortage that's going on right now? And that's, the move, I think, is already in these stocks. But you never know. We could double from here. You just don't know.
Yeah,
it's not something we are investing in.
That's right. It's
Next one, Matt.
Do you guys have a target price that you're looking to exit certain positions? Or because I know we initially started and you mentioned, hey, these are companies, we like the story, the management. We think they could be 10x, 20x, right? Do you have a target price? And within the portfolio itself, what kind of guardrails do you set for yourself? How much do you guys keep in cash, right? Gunpowder to deploy maybe. What does that sit at now, right, for the upcoming year, 2026, with all the big things that we mentioned before, with the Fed in May, tariffs in July with Mexico and Canada? I know you guys don't spend a lot on macro stuff, but I'm just throwing that out there. I was curious.
Well, we know, like right now we're about like 20% cash because we thought things got up like when Oklo was now it's like a $90, $120 stock, but it got close to 200 at one point. Like we took some chips off the table when we think things go. When stock charts go vertical, that's not good, right? It's when the slope gets that steep. But in terms of like, we don't really think of target prices.
Right.
What we think of, like when we look at Oklo, like is it continue to make progress? Like they haven't deployed their SMRs yet. They've gotten through a lot of steps to get there, but they're not there yet. But is the market opportunity there? Are they executing? They just got this relationship with Meta. That's very good. They acquired a company to help them to make isotopes, and that's going to be a revenue stream for them. We think like in the next 18 months, like sooner than I would have thought 2 years ago. So we're seeing them execute well, and the energy market is vast. So we're not going to say when it gets to this point, it's done. When it gets to certain points, we'll take a look at it and say, well, have they expanded the opportunity? No one thought the software as a service market would ever get this big. I thought, I have to tell you, 15 years ago, I thought maybe one day we'll see a $1 trillion company. Boy, was I wrong. There's so many of them now, right? And that leads me to believe we're going to be seeing $10, $20 trillion companies in the future. I can't imagine it now, but it seems like that's only logical.
Right.
And with the Fed printing, that helps make the dollar cheaper. That helps a little bit there. But I just wait. So we don't think that way. We think of if we don't see the growth, and we say it's going to be a sub 10% grower and there's no chance of getting back, then we can exit. But we're always, because the things with the markets, the winners keep finding new markets.
Mark Patopoulos, how would you answer that?
So I think it depends on the situation. So, like for instance, if you had a biotech company and they had one drug, right, and that drug could potentially be a $5 billion drug, and the stock went up to $10 billion, and typically these things would be taken out at say 2 to 3 times, peak earnings or peak revenues from a big pharmaceutical company, and it's kind of getting there already. It's probably limited upside, so there's certainly no point in having a large position. So either you sell it out or you trim it back. If on the other hand you have a company with 7 or 8 different products and each of them could be a big product, and as long as they're executing, then yes, I mean you could let it scale up quite a bit. The biotech sector's, as I said, it's been out of favor for a while, but it had a nice big run the second half of last year. So we're also sitting at about 20% cash right now, taking a bit of profits off some of the some of the winners. Some of the companies that we own, like Sidara, are now acquired, so we've got the cash from some of those acquisitions. So, certainly, we're going to be patient right now rather than just deploy all that cash again. Valuations have run. If we see opportunity, we'll certainly step in and buy it. But, it's hard to ignore a huge move like that and not think, okay, maybe there'll be a period of digestion over the next few months or so, which will present some better opportunities to deploy that cash.
All right, so we're going to stop it here. We're going to be walking around the room. If you have additional questions, you could ask any of us. Thank you all for being here tonight. Mark and Mark, thank you very much. Appreciate everything. Well done. Enjoy the rest of the evening, everybody.